Well, it's been an excellent year so far for stock investors. Can they count on a strong second half? Hugh Johnson joins us now. He's the chairman and chief investment officer at Hugh Johnson Advisors. Hugh, great to see you. So right straight to the main question. Is the second half going to be good as the first?
It's hard to imagine that you could get another half in the same year that was as good as the first year. First part of this year, obviously we had a rise in stock prices. That's not a big surprise. A rise in interest rates. That's not a big surprise. But the magnitude in the first half was really spectacular. No, I think the trade-off, unfortunately, is that we've had a big move in the stock market. It's become a little bit overvalued. So in the second half of the year, although stocks could continue to rise, you're not going to get anything that looks like the first half. So let's call it good but not great, and maybe even a modest correction as we move through the third quarter of this year.
If I generally have a 50-50 stock bond mix in my portfolio, Hugh, where should I be right now? Should I be at 50-50, a little more overweight stocks, or what?
I think one of the most important points, Tyler, now is that the bull market in bonds is behind us. We've probably started a bear market in bonds. Bonds are not the place to be. We're still in a bull market in stocks, so stocks are going to be the place to be. Bonds are not going to be the place to be. If you have a 50-50 portfolio, I would have at least 57.5 or 60, something like that, % of your portfolio in stocks and the balance in bonds. And in the bond part of the portfolio, make sure you keep the duration short. The stock part of the portfolio is going to perform the best between now and the end of the year, and particularly between now and the end of 2014. Look for the returns from the stock market to be roughly the 6% level through 2014, and maybe minus 1.5% in the bond market as a guess.
Okay. So let's talk a little bit about strategies, Hugh. You said that there still could be a correction in this third quarter. So
yes.
Should investors buy when those corrections are happening and scale back in the rallies? What are you telling investors to do?
Well, you know, I don't like to call it short-term swings, Susie, but I think that the market's about 2 to 4% overvalued. What I'd like to do is I'd like to, as an entry point, I'd like to be buying at a lower level, a cheaper, a better undervalued level. So I'm saying, yeah, you want to have that 57.5% in the stock market, but drag your feet if you're going to be adding to the equity component of your portfolio, simply because, one, we're overvalued, and common sense alone says after the first half of this year, you're bound to get a correction and maybe even a sharp correction along the way. My guess is in the current quarter, the third quarter. So I'm saying buy, but drag your feet before you enter.
You know, Hugh, I have a vision of a lot of viewers sitting at home with a hot dog in one hand and a pencil in the other, and they're going to want to use that pencil to write down some stock choices that you'd be comfortable with owning in the second half of the year. Give me a couple names.
Well, you want to go with what's been working. Consumer discretionary stocks have been working. Couple of names that I own and all our clients own: Coach, Disney. In that sector, the financial sector has been on fire. I think their margins are going to expand. First Republic, Fifth Third, on two good financial names. And the healthcare sector has been doing extraordinarily well. A good place to buy, price-earnings ratios low, good dividend yields, safe place to play the healthcare sector and the drugs. Take a look at Merck and Pfizer in that sector. So those are some names, but there are lots of names out there. And again, drag your feet, buy a little now, and wait for that so-called correction that I think will be coming, and then buy some more.
Real quickly, on Friday, that important jobs report comes out. What do you think that's going to do for the markets?
Well, that's pretty important because that's going to get everybody talking about what's going to be the impact of jobs numbers on Federal Reserve policy. At what point does the Federal Reserve begin to taper? I think the number is going to be about 165,000. I don't think that's going to be enough to inspire or encourage the Federal Reserve to even talk or think about tapering or reducing their quantitative buying or stimulus at this juncture. It's when we get in the fall, when we get in the September, October, November, December time period, that I think you're going to see numbers around 200,000 plus in job growth, and that's when the Federal Reserve is going to be seriously considering reducing their buying or their stimulus. And of course, it depends on the inflation numbers, as you know.
Hugh, great to see you. Thank you so much. Enjoy the holiday.
My pleasure.
Hugh Johnson, Chairman and Chief Investment Officer at Hugh Johnson Advisors.